Be emotional here, as I know we're going to Morgan Stanley.
Yeah.
I'm supposed to be up in New York, and my family's gone gluten-free because they're having a gluten-free birthday. They're having a birthday today, and I'm doing my duty in Washington. It is the birthday, John, of Vet Bill.
Oh, happy birthday, Vet Bill.
Today is the day for Vet Bill.
That's special.
And for those of you on radio, Vet Bill is styling the cashmere this morning.
Sometimes when you tune into this show, I think you're probably wondering, is there no news, nothing to talk about? Happy birthday, Vet Bill. There are some Morgan Stanley numbers about 4 minutes away. I assure you, we'll bring you those numbers in a moment. Bank of America was decent, tidy. The stock's doing nicely. Your equity market's up 0.75%. From New York, heard on radio, seen on TV, this is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Morgan Stanley earnings coming at any moment now. From New York City this morning, good morning on radio, on TV. This is Bloomberg Surveillance alongside Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Your equity market up 0.7%. Your numbers drop now from Morgan Stanley. Third quarter net interest income, $2.06 billion. The estimate, $1.71 billion. That is a beat. Institutional investment banking revenue, $2.85 billion. Your estimate, $2.1 billion. That is a beat. Wealth management net revenue, $5.9 billion. Estimate, $6.1 billion. Just shy of that there. Third quarter net revenue, $14.8 billion. The estimate, $13.92. We get into sales and trading revenue. The equity spot has been a good spot for the likes of Bank of America and JP Morgan. Revenue comes in at $2.88 billion. The estimate, $2.42 billion. That is also a beat. Some of the headlines there for you. Sonali Bassett looking at this too. Morgan Stanley breaks 100. We're at 1.5% in the pre-market, Sonali.
Morgan Stanley breaks through. That equities trading number was the one I was really watching for because JP Morgan's massive beat yesterday. Morgan Stanley maintains its lead at $2.8 billion, biggest equity shop on Wall Street. Let's see what Goldman has to deliver us tomorrow. I would say the global wealth management revenue, according to our estimates, had come in a little bit lower than expected. So that is something that analysts might ask about in terms of, you know, what the growth rate is there, what the drivers are there as of right now. But again, that solid beat in equities, John, it's really all Morgan Stanley had to really deliver this quarter around.
Sonali, where, if anywhere, are we seeing the effects of the E-Trade and Eaton Vance acquisitions here in the numbers? Can we see that yet?
Well, it's funny. We could see it in the cost ratio because when you look at the other banks, Morgan Stanley had done well by guiding early on that their efficiency ratio could be between 69 and 72%, which is getting a little bit higher than its rival investment banking counterparts in those businesses. But Morgan Stanley has Eaton Vance and E-Trade to integrate. So to your question earlier, Lisa, at what point are investors rewarding a bank for growth? You see it in Morgan Stanley's stock as their market cap today is bigger than it was yesterday and still bigger than Goldman Sachs. That differential, I think, you know, your Christian Bolu likes to call it the MSGS Combine, has been a talk of the town for many months now.
Yeah, and we are seeing Morgan Stanley shares up about 1.5% in pre-market trading as people parse through the details. I want to go to the net interest income, the idea that it also beat here following what Bank of America showed, including the first quarter-over-quarter credit card loan growth going back to before the pandemic. How much are we starting to get hints that the consumer is starting to borrow more, that companies are starting to look to banks as lenders again?
It is so important to recognize that the clients of these banks are all different. From Morgan Stanley, yes, E-Trade gave them a new, bigger, younger audience, but their clients are very wealthy compared to the big consumer banks that have a much broader set of America. JP Morgan in their statement yesterday said they were intentional about also opening in a lot of low-income areas as the biggest, the bank that serves the most households in the country. But at Morgan Stanley, why is this a big deal? Because they are really trying to grow that lending book, and you are seeing that net interest income pay off for them today as things start to come back.
Janani, stay close. We'll get another final word from you in about 5 minutes' time. Also got Citigroup coming up at the top of the hour, 8 a.m. Eastern time. So in about 27 minutes, Morgan Stanley up in the pre-market by 1.65%, a breakthrough 100 on Bank of America, up by 2.69% there. Bank of America numbers tidy, likewise with JP Morgan, again with Morgan Stanley. Let's talk to Stephen Bigger now, Financial Institutions Research Director at Argus. Stephen, let's start right here. Your view on the numbers we've seen so far from Morgan Stanley, Bank of America, JP Morgan. What's the number one takeaway for you?
Well, I think certainly it's been a powerful, third quarter for capital markets activity. Equity underwriting, IPO activity in particular. It had over 100 companies that went public in the third quarter. Pipeline looks very strong. There's, when you include SPACs, there's over 500 companies that currently have registrations with the SEC. So, just a great pipeline. One light spot, fixed income, currency, commodities. There wasn't quite the volatility in the third quarter. Another thing to point out would be loan growth. We, saw that bottom over the summer, according to Fed data, and that's starting to pick up again. So I think for the regional banks, you've got an improving story there as well.
Stephen Bigger, this is really important. James Gorman has the respect of everyone on Wall Street. Without question, he was the manager of a decade with the move to wealth management. Everybody likes to talk about this other stuff. What I see is $6.2 trillion with the bolt-ons of E-Trade and Eaton Vance. Is Morgan Stanley going to begin to rival BlackRock at 9.x trillion?
Well, I'm sure that's a goal of theirs, and these bolt-on acquisitions, as you say, are, a terrific place to try to get there. These were incredibly well-timed acquisitions for Gorman. You think about E-Trade, right prior to the pandemic, they closed that one right before trading, volume soared. So, just a perfect blend with their asset management, wealth management units.
Yeah.
And I think that puts them in a great place, looking out the next several years.
John, I can't emphasize enough, John, how invisible James Gorman is, say, at Davos or any other thing. He loves to play it low, but this news of how he's saved, stabilized, and expanded wealth management is one they're going to be writing in MBA textbooks 20 years from now.
It's why we call him the quiet man on Wall Street, Tom.
Yeah.
There's nothing pretentious about it when you meet him, when you sit down with him. Stephen, you said it was well-timed. I remember at the time when those acquisitions were made, we were talking about the ding-dong high, the equity market going into a shutdown, and people were saying this was terrible timing. Stephen, no one could have predicted the pandemic. What was it that this C-suite thought, yes, we need to do something, we need to build out, and we can't do it organically? What was it?
Well, I think, if you think back to the time, there was a bit of a scramble, for assets, for acquisitions in general. The more waning days of the Trump administration, they thought they'd have probably an easier time in absorbing these, getting through the regulatory issues, and they're just great franchises, I think. And when you think about wealth management generally, I think what he saw in this unit, and they had a more of a fledgling advisory unit as well in E-Trade, and that could be blended and leveraged with the existing. So I just think there was the range. It was a bit of a leap of faith, given that the commissions at that point had gone to zero. You've got to make money in other ways, clearly than just trading commissions. But just the whole franchise, and Eaton Vance kind of fit that same mold.
Yeah, and
I would call Mr. Gorman, by the way, strategic. They say he's the low manner, kind of low key, kind of quiet. But he's very strategic. He's looking out. He's not spending a lot of time on maybe the TV talking about these strategies, but
we noticed. James,
you could spend a little bit more time talking on television, just our unbiased professional opinions.
Good morning,
There is a
Mr.
question. He is just saying this, this by Max Abelson of Bloomberg News, noting that James Gorman wrote, year to date, our successful integrations of E-Trade and Eaton Vance have supported growth of $400 billion in net new client assets across wealth and investment management. When we talk about assets, how important, Stephen, is it that we are starting to see some consumer lending pick up at the likes of Bank of America, and we're seeing net interest income beat at Bank of America and Morgan Stanley?
That's huge, actually. Bank of America had a nice chart in the presentation about how loan growth sort of bottomed in the summer and has started to pick back up again. So, I think as the pandemic recedes, as the companies which went gangbusters last year on fixed income issuance and building up that corporate cash hoard ahead of the what was expected to be a longer downturn, that haven't needed the cash in the last year, are starting to come back out of that and starting to take some credit down again. And consumers, in particular, credit card lending, certainly expect that to pick up. Home lending has been pretty strong. But yeah, the key here is that the higher interest rates that we expect are not going to do them much good unless they can put some new loans on the books. So as the economy recovers, loan growth improves, a steeper yield curve, great capital markets environment, we're very favorable on financials at this point.
Stephen, Ken Leon was on earlier, and he was saying that he likes Wells Fargo over Bank of America, not because he thinks that they're such a stronger bank, but because there's more upside there. Do you agree? What's your takeaway in terms of specific calls following what we've seen on a preliminary basis?
Well, we have buys on both of them, and sort of for different reasons. Bank of America clearly is benefiting across the landscape with their consumer franchise, institutional, capital markets, all doing well. Wells is a bit of a special case, right? They've got the asset cap, which we expect at some point will be lifted. Feel that it should have been already, probably, but they've had some additional missteps and are kind of getting through that. So I think that's a big catalyst for the stock when that does get removed. They are absolutely handicapped on loan growth and asset growth until they can get that removed. In the meantime, they're focusing very much on costs. So we're seeing that coming down. They've talked about the $10 billion that needs to be saved to be much more competitive with the large banks, and I think they'll get there. But it will take some time, and the asset cap is critical here. So the bias for different reasons.
Stephen, can I just say thank you? I know this is the biggest day of the quarter for you, the busiest day of the quarter. So thanks for giving us some of your time, especially after Morgan Stanley numbers drop. Morgan Stanley numbers decent, JP Morgan decent, Bank of America decent. This line comes from Max Reyes here at Bloomberg. Lisa, Wells Fargo headcount as of the third quarter was 253,871. JP Morgan, 265,790. Wells Fargo no longer the largest bank by workforce in the United States.
They've been focused on cutting, and people are still saying they're not cutting costs quickly enough while the other banks are expanding at the fastest pace that we've seen in a very long time. You start to wonder at what point these expenses, how much the cost ratios start to bite into some of the questions, into some of the performance of the shares.
Can I also say that James Gorman heard us and that he's going to join Shanali at 10:30 Eastern Time.
Thank you, James.
Did he hear us, Shanali?
Oh,
Did you just book this one right now?
He's having a good day, it looks like, and investors are agreeing.
Shanali, looking forward to catching up a little bit later on this. Busy day for Shanali as well. Go on, Tom.
John, if I come on with Mr. Gorman, can we talk Australian football?
If you do that, I'll come on too. Will Shanali let us, though, Tom, to talk about
he likes Vegemite.
The Brisbane Broncos?
No.
I think this is the reason he's on at 10:30, Tom, and he's not with you and I in about 20 minutes.
Exactly. Shanali, first question. How do you like your Vegemite?
From New York City this morning, run Shanali. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. President Biden is heading to global climate talks at the end of the month, weakened by infighting at home. He has embraced climate action as no other U.S. president has, promising to cut carbon from grids and shifting to electric cars. But U.S. negotiators at the Glasgow summit may have nothing to show other than promises of action. A down payment in funding to help poor countries fight climate change is unlikely to clear Congress this month. The White House has once again said it will support former President Trump's assertion of executive privilege over records related to the January the 6th insurrection. It's ordered the National Archives to turn over documents to congressional investigators within 30 days. The former president has indicated he might start a legal challenge to keep the records shielded. A new bill in the U.S. Senate would crack down on big tech companies. Firms like Amazon and Apple would be prevented from giving an advantage to their own products over those of competitors. They would be barred from using data to hurt competition, stacking search results in their favor, or restricting the way other services use their platforms. Taiwan's semiconductor manufacturing is calling for a bullish end to the year. The world's largest chip maker forecasts fourth quarter sales and margins that exceeded some estimates. Demand for semiconductors has stayed robust in the face of growing disruptions in the supply chain. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How is Ireland dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is how we're set up this morning. Live from New York City, this is Bloomberg. Equities advancing on the S&P by 36 points. We have a lift on the S&P 500 by 0.8%. That's a nice lift. We add to the gains from yesterday. We add some weight to this equity market. In the NASDAQ 100 futures, we advanced 136, up by 0.9%. That lift is broad-based this morning. Yields come in about a basis point on Treasuries, 152.64 on 10s. Lisa, work with me here at the front end. For me, that's where my attention is at the moment. It's that rate hike debate just getting pulled forward all the way through to the very front end of the yield curve on 2s. And then now talking about what? Back end of 22?
Yeah.
Going once, going twice. I sound like an auctioneer, but that's the conversation at the moment.
And frankly, the auctioneer has a lot of securities that are hinged on what he has to say. I was actually just looking at the gap between 3-year and 2-year yields. It's at about the steepest level going back to 2017 as people try to price in some of the rate hikes. And yet we are seeing those longer-term yield curves flatten out as people expect them to get ahead of some of the longer-term inflationary pulses.
The banks would like to see higher rates. Here's a picture of the banks for you right now. Let's take a look at Morgan Stanley. Take a look at Bank of America. Numbers out this morning. I'll keep it simple. They were good. For Morgan Stanley, as Shonali Bassett pointed out earlier this morning, equities for Morgan Stanley, very, very important. Strong for JP Morgan, strong for Bank of America, and better than strong for Morgan Stanley, up by 1.7%. For Citigroup, we advanced by 1.25%. Those numbers come up in about 11 minutes' time. We're getting a fuller picture of the banking universe on Wall Street, though, and Citi so far for investors. Investors like what they hear. That stock advancing by about 90 cents. Want to finish on this, guys, and we can talk about it. Dollar lira through 9. Dollar lira through 9 and up 0.8%. That right there is a weaker Turkish lira. Off the back, Lisa, of the president of Turkey firing 3 more central bankers of the Central Bank of Turkey. And let's be clear right here, there is pressure on this central bank to cut interest rates further. That's not the story elsewhere in EM right now. They are hiking, and they are hiking big time. Chile, the latest.
The idea of trying to attract capital at a time when more money has been going to developed markets that are accelerating faster and considering tightening policy. Turkey is its own story. There is, shall I say, an unorthodox belief by President Erdogan that if you lower rates, that will reduce inflation. That has not been established or agreed upon by pretty much anyone else.
That's the diplomatic way of putting things. Joining us now, Damien Sasser, Chief Emerging Markets Credit Strategist for Bloomberg Intelligence. Damien, let's start right there in Turkey. The Turkish Central Bank, let's be clear about this, looks very, very different to what else we're seeing elsewhere in EM. Your take, Damien?
Yeah, I think we've seen all this before, Jonathan. I mean, they try to impose their dovish view on the market. The market reacts by selling off the lira. The Turkish central bank has to burn through its FX reserves in order to prop it up, and then the hiking cycle begins anew. So, yes, I mean, of the 20 major central banks, you rightly point out, 11 have eased rates since May. Turkey's obviously not one of them.
Damien, tightening rates elsewhere at Chile, Colombia, Mexico, Brazil, South Korea. Singapore, take your pick, Damon, I'm losing count. Typically when something happens in emerging markets, the EM pros like yourself come out and say, but John, you don't understand the nuances on the ground. This is idiosyncratic. This doesn't feel idiosyncratic looking at the central bank universe in emerging markets right now.
No, it doesn't. I mean, I know Mohammed used idiosyncratic earlier. I know how much we love that word, but you're absolutely right. Look, I mean, the reality is there are 3 things that are driving, EM currencies to depreciate. And that the first and foremost is this developed versus emerging market growth differential, which is actually expanding, right? Or, basically developed markets are growing more quickly. It's the inflation impulse, which Mohammed referred to earlier. And then obviously it's this term premium buildup in developed market yield curves. I mean, look at the U.S. yield curve, the steepening therein. We have higher yields at the long end that kind of feeds into emerging markets, forces central banks to hike. And that's typically not a very good environment to be in emerging market assets.
Damien, how perilous is it in certain parts of the emerging markets complex? We heard Mohammed El-Arian talking about potential serious issues. What's your view?
Yeah, no, I mean, I think the IMF flagged many of them. I mean, the fact of the matter is, if you look at debt to GDP across the whole of emerging markets, it surpassed 100% now. So, there is definitely debt building in emerging markets. They're going to need to repay this debt. Their interest expense to fiscal revenue is at an all-time high. So this is all negative. Once rates begin to tighten, growth begins to slow, it could be a really bad cocktail for emerging market investors, and central banks are going to be struggling to catch up here.
So which areas are you most concerned about?
Well, I mean, I think, it's got to be anything denominated in local currency, right? Even though that's pretty much borne the brunt of the downturn here in terms of from an investor standpoint, I really still think you have to stay away from local currency assets. We might see fund flows or capital flows turn the other way, and that would be obviously very negative. But now we got to start looking at EM dollar credits. So look, let's be clear. Turkey, while it has a very small piece of the pie in EM local debt, it's actually 4% of EM dollar credit. It's the second largest issuer of EM high yield credit. That's been a place that a lot of global investors have gone to get that excess yield.
It's such a good final point. Damien, always good to catch up, sir. Hopefully we'll touch base in a couple of hours again. Damien Sasser there of Bloomberg Intelligence. This is the ultimate EM dilemma. We talk about it a lot on this program, and Tom, EM has been used to it for a long, long time. Upside risk to growth, inflation rather, downside risk to growth. The EM conversation is a simple one. When you face that dilemma, typically the market pushes them to tighten monetary policy. That's what we're seeing in Chile, Mexico, Brazil, South Korea, Singapore, as Damien pointed out, Tom. I'm losing count. Colombia in the mix as well. The question I think a lot of people are asking increasingly is whether that EM dilemma becomes a DM dilemma. An emerging market story becomes a developed market story. Tom, that remains to be seen.
Yeah, I agree with that. That it could, there could be contagion over into other systems. John, the overarching question here is, do the emerging market countries, not all of them, but selected ones, do they have a new mature financial structure where they can go it alone or adapt and adjust in crisis versus dialing 1-800-GORGIEVA? And that's a major theme here. Is this a new EM world where they're more mature financially so they have the tools amid crisis?
What are they saying about it right now, Tom?
I think it's a raging debate, all of it derailed by the distraction, as Dr. El-Arian talked about, of the World Bank and the IMF and data transparency. It's a most odd set of meetings here. But the real question is, and it's all wrapped around China as a single word in the discussion, the real question here is whether EM, is it the old EM or is there something new going on?
Tom Keene, Lisa Bramett and Jonathan Ferro from New York City this morning. Coming up shortly, Nadia Lovell of UBS on this equity market lift, up 0.9% on the S&P from New York on radio, on TV. This is Bloomberg.
I'm Jamie Maggio with another exclusive BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. The first women's semifinal is set, and a huge upset in the men's draw Wednesday at Indian Wells. Two-time champion Victoria Azarenka had just too much for Jessica Pegula as she powered her way into the Final Four and put her in the semis for the fourth time in her career.
When you're adding something new to the game, it feels like you're kind of starting from the beginning, and so I'm really happy, and I'm motivated to keep going.
Earlier, Grigor Dimitrov upset the U.S. Open champ and top seed Daniil Medvedev, the Bulgarian fighting back from a set and 4-1 down against the Russian. Dimitrov took 11 of the last 14 games in the amazing comeback win. He'll face Hubert Hurkacz in the quarters. And don't forget, Tennis Channel's exclusive live coverage hits the air daily at 10 a.m. I'm Jamie Maggio.
We can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Bloomberg surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
It's not really about whether banks beat on this numbers this quarter. It's more about what's driving the beat on this.
I think we're going to find out that companies still see a lot of top-line growth.
As the COVID problems fade away, I think that's going to be the real catalyst to bring everything back to normal.
Earnings season is going to give us a really good clue of where we're going on some of these supply issues.
It's either inflation or growth, and it looks like we're having a little bit of both.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance from Washington, from New York, with the Citigroup earnings, and it is a bank that separates out transformation, strategic refresh, and culture and talent. Of all the banks, John Farrow, Citigroup is different.
Let's get to the numbers, Tom. We're finding out that in the third quarter on Wall Street, things were okay. The earnings are out from Citi. Fixed sales and trading revenue, $3.18 billion. The estimate, $3.08 billion. The beats, the big beats, the big lift year over year has come from the equity business for Bank of America, for Morgan Stanley, for JP Morgan. Citi's no different. Equity sales and trading revenue, $1.23 billion. The estimate, $909.4 million. Investment banking revenue, $1.92 billion. The estimate, $1.54 billion. The story for the equity, for the stock, we're up by 1.34%. We already had a full picture of what was happening on Wall Street coming into these numbers, given the beats we saw from Bank of America, JP Morgan, and others. Morgan Stanley in the mix as well this morning, Tom. Citi's up. The numbers are decent. Shanali Basek's still with us. Shanali, your read, your early read on these figures.
Huge beat on the equities business, and they did beat in fixed income as well. Their traders are holding on strong, and the investment banking division also doing well. Remember, Citigroup up there in terms of the top underwriters in the world in equity underwriting. I do have to also point out that when it comes to global consumer banking, the revenue has dipped quite a bit, about 14%. Lower card balances was part of that. When you look at the international business, a lot of weakness in Asia as well. So there will be some questions about that. But again, the core business is doing quite well. Citigroup has a much more global footprint than some of its peers, say Bank of America. So how it's doing around the world will also be of interest as we parse deeper through those numbers.
And as a lot of the traders parse deeper through those numbers, the stock continues to go up pre-market trading, now almost 1.8%. We have seen an underperformance, pretty dramatic underperformance of Citigroup versus the other banks coming into this earnings report. Why has the bar been so much higher, frankly, for Citigroup to seem valuable to traders?
Listen, they have a lot of regulatory issues. We saw the same thing with Wells Fargo, and they were very suppressed earlier last year. At some point, Wall Street turned around and said, okay, they're cheap. Let's get in there. They're turning around enough. Jane Fraser is like about 6 months through the job, right? So once there's more time, if they start to make progress on those regulatory issues, then you may start to see the story start to turn around. Plus, they just started embarking on a lot of these changes when it comes to their global wealth and consumer business. So seeing that take shape is what investors are waiting for. You know, you have Mike Mayo even doing a sum of the parts.
Shanali, thank you for weighing in on this. I think this conversation around Citi is going to continue for a long, long time, Tom. Citigroup up today by just 0.03% right now in the pre-market. We drop off the highs. For the stock, 70.28. But Tom, over the last 10, 15 years, since the financial crisis, as you know better than anyone, this stock has severely underperformed.
Yeah, I must admit, I'm still scarred by the 10-for-1 reverse split. You look at $70.57. I move the decimal psychologically, John, to $7.08 per share after the shenanigans of 08, 09. What's stunning to me, John, is you look at a given PowerPoint, a given presentation, and you do the Sesame Street thing. This one, which one doesn't look like the others? Citigroup right now doesn't look like the others.
Mr. Corbett had a tough gig, Tom. Mrs. Fraser has a tough one too.
You're dead on. It depends what the cards they were handed, with major credit to Brian Moynihan for what he's done at Bank of America. Ken Leon is with us. And Ken, I want to go to the PowerPoint, the Fraser PowerPoint, and I want to make real clear what sticks out to me is the challenge to narrow the return gap. What does that mean in English?
Well, it means, first of all, Citigroup shares are still trading lowest in terms of price to net tangible book value at a discount. So the market is looking for catalysts. It's not necessarily just normal operations, but what do you do with disparate businesses around the world, particularly in Latin America and Southeast Asia? They did a bit of that 2 quarters ago, but the market, or even Mike Mayo, is looking for some bigger catalyst, which is really, how do you streamline this bank? Jane Fraser's a management consultant background, no different than James Gorman. So the wheels are spinning, but I think it may have to wait for Investor Day later in the year. It's not going to happen today on the earnings call, but Citi, again, is a laggard to the other banks, which have a much bigger focus in North America. That's the big difference.
Ken, I want to dig a little bit into this 40% increase year over year in equities trading revenue, far beating estimates when it comes in at $1.23 billion versus the $909 million, John was saying earlier, that analysts were expecting. What do you make of this at a time when banks are trying to toe the line between taking on more risk, appealing to regulators, and at least showing that shareholders that they can drive revenue going forward?
Well, there's 2 parts to that. First of all, we don't like to look back, but it was a weak quarter last year. Citi's been actually hiring like crazy last year into this year in equity trading. So I think that speaks to the 40%. In terms of regulation, we're fine. It's the risk measure that banks are taking was telegraphed, of course, with the June Fed stress test, and they came through in flying colors. So I'm not too concerned about equity trading, but the key here is what moves these stocks is recurring revenue and return of capital. So you don't want to take outsized risk or into the level 3 assets of derivatives because you have to put more capital to it. Morgan Stanley understands this. Most of the banks understand this. So it's calibrated. It's not trying to hit it out of the park like we saw right before the financial crisis.
Ken, on behalf of all of us at Team Surveillance, thank you so much for your time commitment here from CFRA this morning. It's really world-class analysis on these important and very large banks. Right now, and this is a joy, with partnership out of math and physics at Smith College in New England, Nadia Lovell joins us, holding court at UBS, is senior U.S. equity strategist. Nadia, it's all about the calculus. It's all about the rate of change. I want to go Newtonian on you. Are we overemphasizing the earnings disaster to come, and will we be surprised how dampened the disappointment is?
Yes, we think so. We think that companies are going to put up a solid third quarter. Earnings growth rate and the beat rate obviously is going to meaningfully moderate versus what we saw in the second quarter results, where we saw EPS up by 88% year over year. But we still think that companies are going to beat. We're looking for the third quarter, 30% year over year EPS growth. Of course, shortages both on the labor side and the supply side does remain a risk to earnings, but we think that this has been well telegraphed. We've had so many negative pre-announcements already, mostly concentrated in industrials, consumer, as well as some parts of hardware tech.
We've been talking this morning about the greater delta in the banking world, that Wells Fargo maybe has a bigger delta move than the other banks. And let's go Greek letters. Where's the sector that's going to give me alpha out 1 year?
I think I would look closely to energy. We continue to like energy despite the strong year-to-date performance. We think there's still more room to go. Obviously, the sector does benefit from higher oil prices, but I think beyond that, they're showing that they are better stewards of capital. And so they're more disciplined in their CapEx investment. They're starting to return more cash to shareholders. And when you look at energy, it has the highest free cash flow yield, the highest dividend yield, the most earnings momentum right now. And we just don't think that the sector is pricing in where oil prices are right now. We think the sector is pricing in something in the high 50s range for oil prices, much below the current spot and also the 2-year strip. So that's an area I would look to add to.
And Nadia, really good to catch up again. We'll talk a little bit longer this morning. We'll have another segment with you. Just a final question on this one. How do you get to 5K year-end next year if your bets are concentrated in, say, energy, financials? Let's talk about the path to 5K, Nadia. How do you get there?
Yes. So financials, energy, consumer discretionary, and healthcare. We do think that healthcare will start to perform well, and that's how we're getting there. We also are looking for very healthy earnings growth, 45% this year, 10% next year, and that gets you to 5K at the end of next year.
Wow. Tom, some big numbers coming out of UBS.
Well, yeah, and what's interesting here, and of course I think everybody hears how I'm a little frustrated by the gloom, is it's about the level of the gloom where, John, there will be gloom. I take the point, there's going to be some ugly margin issues, but will it be sort of ugly or big ugly? And certainly we're hearing from Ms. Lovell that, you know, get over it. It's not going to be as ugly can be.
I'm very happy to say that Nadia is going to be sticking with us. Nadia Lovell joining us for another segment from UBS with a 5K year-end price target on the S&P 500 year-end next year. Your equity market right now, a real lift at 41 on S&P 500 futures, advancing here, Lisa, by almost 1%. This equity market's looking good right now. Yields in a basis point on 10s, 152.64.
One of the most optimistic notes from some of the financial earnings that we've heard so far is consumer lending. You're starting to see signs of it. The idea that credit card lending is starting to pick up again. The idea that the consumer, yes, they're flush with cash, but they also still want to borrow because they want to spend so much, despite supply chain disruptions, despite all of the concerns that people have.
We've got to have a conversation about one of those concerns, a clinic on inflation with Adam Posen, the president of the Peterson Institute. We're going to do that in about 20 minutes' time. So the last hour of this show this morning, it's going to be a good one. Futures up 42, advancing about 1% on the S&P 500. From New York City this morning, Tom Keene, Lisa Abramowitz, and Jonathan Ferro.
Right?
This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Last month, Federal Reserve officials agreed they could start reducing emergency support for the economy in mid-November or mid-December. Minutes of the policymakers' meeting showed that there was increasing concern over inflation. Most participants saw inflation risks weighted to the upside. They also discussed whether labor supply would bounce back to 2019 levels. Now in China, factory inflation grew at the fastest rate last month in almost 26 years. The producer price index rose 10.7% from a year earlier. Coal prices and other commodity costs soared. That could add to inflation pressure if local businesses start passing on higher costs to customers. There's more pressure on what was already a sizable supply defect in the oil markets. According to the International Energy Agency, shortages of natural gas in Europe and Asia are boosting demand for crude. The IEA says that could add about 500,000 barrels a day to oil use over the coming 6 months. Mixed results from Domino's in the third quarter. The pizza chain reported revenue that missed estimates. Sales at domestic stores fell almost 2%, while international sales rose almost 9%. Meanwhile, Domino's profit was better than expected. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
Might it impact China's growth because it is already slowing? Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Cannabis remains very strong even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The market is telling the Fed two things. One is get going with tapering, we can take it. And two is you're not going to be able to separate cleanly tapering from rate hikes. Look at the numbers today. Look at PPI in China. This is a very hot inflation environment, and the longer the central banks wait, the greater the risk.
The beauty with Mohammed sometimes, he speaks in such simple terms, but it captures where we're at, a complex moment, perfectly. This is the moment we're in. Hotter inflation, how do central banks respond? And this bond market's responding at the front end of the curve over the last couple of days. From New York City this morning, good morning. That was Mohammed Al-Arian. Much more on that conversation through the day on Bloomberg TV and on Bloomberg Radio with Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity market up 40, advancing 0.9%. Up and away. In the bond market, yields unchanged, 153.34. And looking ahead to next year, the call from UBS, Tom, 5K year-end 2022.
5K year-end, the Bears really having trouble getting around that, and of course it is a bit of an extrapolation. Now, John, I would mention off of Al-Arian's world-class game theory that he would suggest this is a world of narratives right now, John, of T decisions, and it's never a T decision. There's too many independent and even dependent parts here as well. The mystery here, John, right now in synthesizing economics into where we are, finance and investment, to me, it's record low.
Tom, the dominant narrative for 2022, I think, is up for grabs. We've got to work this out through the next 3 months. Right. We're at one of those weird inflection points where the incoming data is starting to increasingly challenge the popular narrative. And that popular narrative, that word, begins with a T.
The popular narrative is to do the work, and UBS has done the work for some real caution. They have made a house shift to optimism. Nadia Lovell continues with us, their senior U.S. equity strategist. Nadia, I want to talk about what we see in big tech and the surprise maybe we see it in other sectors as well, and that is the idea of the issuance of new debt, still with low rates, still with low real rates, that moves right over to use of cash. So we have use of new debt to be used in use of cash for shareholder buyback. Do we underestimate that trend?
We do underestimate the power of shareholder buybacks. You know, we have seen a pickup in buybacks announcement this year. Actually, buybacks announcements are on pace to be near record level, as we saw post the last administration, corporate tax reform relief. And so historically, buybacks has added about 200 basis points to EPS growth. And so that could be a real tailwind as we get into 2022 and corporations return more cash to shareholders.
Madame Lagarde spoke today in Washington, the European Central Bank president, of the second round effect. What is the second round effect for corporate officers right now adapting to the economic cards they've been given?
I think that corporations have to continue to manage that expense side. I mean, we saw some of that coming through the banks this morning and yesterday in terms of concerns around a pickup in interest rate, in expenses. We also have to watch that from a wage growth standpoint. We're seeing a pickup in wage growth. That is something that we're closely watching because that tends to be a lot stickier. And we know a lot of people are sitting out of the job market for a potential increase in wages.
One of the most interesting aspects of the optimism that we're feeling this week is that it comes in tandem with pricing in rate hikes sooner rather than later. Right now, the expectation is for at least one rate hike next year and potentially two or more in 2023. How much does that fly in the face of this 5,000 S&P call of yours by the end of next year?
We are looking for rate hikes to begin in early 2023. Now, of course, a lot of this is going to be data dependent. You know, obviously, everyone is watching inflation, watching the recovery in the job market, and also watching for a potential reacceleration in economic growth. We don't think that the Fed will move to preemptively. We think that the Fed will be more cautious. Obviously, we'll get tapering of asset purchasing program later this year, but we aren't looking for rate hikes into 2023. Even if rate hike gets pulled forward by one rate hike in 2022, we still don't think that derails the equity market story.
What about two? And what's the breaking point here?
I think that if you start to see 2 or 3 rate hikes in 2022, that will be a cause for the market to take pause. Obviously, then people will become concerned that the Fed might be moving too aggressively. As we know, like historically, outside of the most recent recession, most recessions have been caused by any sort of a Fed mistake. And so that would give us some pause to think that could be policy error here.
Nadia, will we see combinations, transactions that are simply about the dreaded word synergy? It's been sort of quiet this year, I would suggest. As we come out of this pandemic, is everybody going to get the urge to merge?
I think so. You could see a potential pickup in M&A activity. I think that companies have been more on plan because there is a lot going on in Washington around corporate tax reform. What does that really look like? Hopefully, we'll get more details in the next month or so. And I think that will better position companies to look to do M&A in 2022. Companies are flush with cash. Valuations have moved up, as well as company share prices. And so companies might also use that as a way to acquire other companies.
And Nadia, I love catching up with you. Today, no different. It's good to hear from you. UBS's Nadia Lovell there on this equity market. The path forward, a simple one for UBS. I know a lot of this is crystal ball type stuff, but we're really trying to paint the expectations on Wall Street at the moment. And this is from UBS. They have a June target for next year. They have a December target for next year. It's 4,800 and 5K respectively. The S&P 500 closed yesterday at 43.63. Tom, the equity market for them is going higher. They like the cyclicals. They've performed well recently. They're expected to continue.
Check the calendar, John. This is no different than Jim Suva over at Citigroup modeling out free cash flow at Apple into 2024. This is where we begin to see not so much an extrapolation, but really thinking about the backdrop of economics that we cover every day and what it means. And so far, what I'm seeing are very constructive views forward through 22 and into the following years.
The UBS and RBC may be on the one side, Tom. on the other, Lisa, is pretty clear. Morgan Stanley, Bank of America, far less constructive.
They're threading a needle, all of these analysts, and we heard that from Nadia, this idea that all of this optimism bleeds into great earnings, but not necessarily a more hawkish Fed. That is a key question, because right now in rates futures, you could see 1.5 rate hikes priced in by the end of next year. Basically, if we get to 2, as she was saying, that could disrupt the projection for the S&P 500 and target. So this is sort of the dilemma. How do you get that optimism, that strength, without a hawkish Fed?
You need a voice, a smart voice, and that smart voice today, Tom, is Adam Posen of the Peterson Institute. What a timely conversation coming up, Tom, on this inflation dynamic.
Yeah, I think, John, I agree with that strongly. This is a year at IMF World Bank, and we can talk to Dr. Posen about all going down at these meetings. But overwhelming that, John Farrow, is the inflation debate. I think it's a good idea. Stay on that with Adam Posen.
We're going to do that next, Tom. From New York City this morning, Tom Keene over in D.C. alongside me, Lisa Abramovich. Your equity market is doing better than good. It's up 0.9% on the S&P 500. Citi in the pre-market. The numbers, the results, the earnings okay. Up by 1.27%. Morgan Stanley better than okay. That stock is up by 2.36%. And Bloomberg is catching up with James Gorman of Morgan Stanley at 10:30 Eastern Time. From New York, this is Bloomberg.
TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I am playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
This one buried through the morning because of the bank earnings from New York City. Some initial jobless claims data just around the corner. Mike McKee's going to be with us to break that down. Going into it, equity futures up 40, advancing 0.9% on the S&P 500. The equity market looking good. Some PPI numbers out, claims just around the corner. Let's break this one down with Mike McKee. Morning, Mike.
Good morning, John. Well, the producer price index is out, and it is a little bit better than forecast. We were expecting a 0.6 increase in final demand on a month-over-month basis. We get a 0.5 increase, which means the year-over-year number goes down to 8.6. Well, it rises to 8.6%. It was expected to be 8.7. So it's still a significant increase, but it is not what had been expected. The core is up 0.2. That is a lot less than the 0.5% that was expected in the 0.6 of last month, and it pushes the core rate down to 5.9% on a year-over-year basis from 6.5%. So it does look like we are seeing some significant declines in the core side. Final demand for goods is up 1.3% in September. That's the largest increase in since May. In September, 40% of the advance, a 2.8% jump in prices for energy. So energy is starting to feed its way into the overall economy. For services, which is what everybody watches because we are a service economy, up only 0.2%. It is the 9th consecutive advance, though. The increase was up for the most part because of food and fuels. Also, the same kind of story for services as we're seeing for goods. So looks like PPI is the kind of thing that is going to be like CPI yesterday, a chance to debate both sides of the issue.
Right.
Initial jobless claims. Here's the good news of the day. I see John smiling in the studio. 293,000. That's a drop from 326,000, which was revised a bit higher to 329,000. So a significant drop below 300,000. So that is some good news on the jobless claims front. And this is more what we were expecting than the brief bump we had in September.
This is what we want to see, Mike.
Things went up. This is the kind of thing we thought we'd see when we got to September and the benefits were cut off and people were, in theory, going back to work.
Mike, thank you. Tom, back below 300K. It's what we wanted to see.
Yeah, it's an emotional. I don't have the chart in front of me, but as I've said, it's a very elegant trending chart, and that trend is to a better outcome there. We certainly saw that with the unemployment rate, I should say, in the last report. This is a tradition of our IMF and World Bank meetings, John. Adam Posen joins, president of the Peterson Institute, that barely describes his contribution to international economics, a particular focus on Germany, and a really classic moment a number of years ago with, among others, a guy named Bernanke on inflation targeting. John, we'll get to that in a moment. But, John, I understand you understand how sensitive and woke Adam Posen is.
We'll find out how woke Adam Posen is in just a moment. Larry Summers, the former Treasury Secretary, Lawrence Summers, saying in the last 24 hours the following, Adam. Help us out with this one. I'd love your reaction. Quote, "We have a generation of central bankers who are defining themselves by their wokeness." Goes on to say they're defining themselves by how socially concerned they are. Adam, open one for you. What's your reaction to that?
I don't think that's fair. If you want to worry about wokeness, yeah, there's universities you can worry about, there's various individuals, but the central bank is not stomping on alternative voices. It is not saying you can't worry about inflation because we're too worried about unemployment. There's open debate. I just hosted Raphael Bostic, Federal Reserve Bank of Atlanta president, at the Peterson Institute earlier this week. He gave a speech that sounded relatively hawkish. He talked about inflation expectations, and at the very end, I asked him about inequality, and he gave the same answer that most members of the FOMC would. It's entirely right for the Federal Reserve to do research and draw attention to the inequities in the society. Monetary policy has to be focused on the aggregate output, aggregate inflation.
The latter point's the really important point, though, Adam, whether they have the tools or not to address it or not. It sounds like President Bostic doesn't think they do. Do you think there are some on the Fed, though, that believe they do and ultimately want to do something about it?
I think those on the Fed who care about these things deeply, and that's most Fed people, but if you think of the various Fed presidents, there's a lot they can do in their districts. There's issues of bank supervision. There's issues of redlining and housing, where the Fed played a huge role, first in ignoring it and then drawing attention to it. There's issues of education. There's issues of documenting and putting out there what are the disparities. But no, I don't see anybody on the Fed committee who thinks that you're going to use monetary policy to solve inequality problems. And the point is, you can worry about inflation and argue about whether or not inflation's getting out of hand without talking about people's motivations and assuming some kind of soft-headed plot.
Dr. Posen, you have the joy every day of working with Olivier Blanchard. He wrote about the unlikely but not impossible, the modern inflation dynamics we're in. He made worldwide headlines 11 years ago talking of a 4% inflation. We're there. But this is very different, isn't it?
Yes and no, Tom. I mean, Olivier and his co-authors made headlines a decade ago calling for a 4% inflation target because the 2% inflation target Bernanke, Michigan, Laubach, and I and others had pushed didn't take into account enough the zero lower bound and us not having effective monetary
So have
policy.
we committed the experiment Professor Blanchard talked about?
No, because the Federal Reserve and the Congress have not said, hey, inflation's up, let's grab that and say, now that we're here, let's raise the target. Myself, Joe Gagnon at the Peterson Institute, we've been out there saying 3+, now is the time, just like you said.
So do we need a regime change? Do we need a bullet regime change right now to rephrase our generational belief in 2% inflation and say, hey, this is the new normal?
I personally think yes, because and it's not a regime change, it's a resetting of the target. One of the problems that we didn't foresee when we put in place inflation targets was we assumed, it's in the books that we wrote, we assumed that you would be able to reset the target as economic knowledge and circumstances change it. We've never seen targets get raised for inflation targets. It's like an exchange rate. Once you set it, you're scared to move it. And so, as I've said to you, I think before, Tom, but I'm glad we're talking about this right now, we should be opportunistically reflating. We should be saying, okay, inflation's now above 3%. Let's re-anchor it there.
So what do you say to people who argue maybe not stagflation, maybe slugflation, that basically this will slow growth and that prices will come back down naturally? Why do you say that that is not the case, that we are in a regime change, and what data are you pointing to?
Well, just to be clear, I'm saying we're not yet in a regime change. A regime change would be either a fundamental structural shift or the Federal Reserve upping the target. What I do think is happening is we've got so much accumulated weight from these generations of central bankers who were hardly woke and paid too little attention to unemployment that you see the 10-year bond, no matter what fiscal and inflation happens, inflation expectations don't go up. And we saw this in Japan and we've seen this in the euro area. It should be a two-way bet that there's some variability in inflation expectations, and that gives you the flexibility to cope with the kind of structure.
Adam, I've got to jump in. What you're saying is so important. You think that the way they should communicate this is not by making up excuses for it, just by saying this is what we want to see. Is that right?
Yeah, we're fortunate enough to now have a bit more headroom from the zero lower bound. We're fortunate enough to have enough inflation space that the economic adjustments to the labor market need to be done. There was a great paper at Jackson Hole this summer talking about how you get better labor market adjustment when you have loose policy, which is what I said back in '98 on Japan. You should be opportunistically reflating and raising the inflation target and consolidating what we got. And then if that means the 10 years up a little bit, the yield curve steepens a little bit, and there's two-way risk on inflation expectations, that is a win for the economy. That is a win for the Fed.
Except that the bills are getting bigger, and we have to refinance debt. How much is this a concern? What is the threshold for the 10-year Treasury yield that the U.S. economy can tolerate, given the deficit?
It's the 10-year yield doesn't have a single threshold. I'm sorry to be pedantic about this, but this goes back to Blanchard, right, and others. What counts is R minus G, the differential between what interest rate you're paying and how much the economy is growing. And if the economy is growing at the rate it's now growing, the interest rate is going to be lower than that. I'm not going to worry about it. And if the interest rate starts moving up a lot and looks like it's going to stay up, then I worry about it. I do not think a lasting multi-year shift to 3% is going to ruin the yield curve.
So let's conflate this. Blanchard and others, Stiglitz has mentioned it often, R minus G is key. That interest rate as it's related to growth, if the growth's there, everything's okay. Do you believe that what we're misjudging is a technological overlay which is going to give us better productivity, better growth, so we don't have to sweat R minus G?
No, I think we're misjudging the extent of the R risk, the extent to which R can jump. I'd love to have G jumping. I'd love to see a product.
Do you model, and with all your work at Peterson, do you model G jumping, or do the inflationistas completely underestimate the R dynamics?
I'm not quite following, Tom. What I think what we've seen is that you look back at the data, if you've got a large economy with a stable government and issuing debt in its own currency, R stays below G most of the time. If you look at US or Western European or Japanese history, you get R jumping usually when there's a political problem. And that's where I worry about the US, not some threshold as was being mentioned. I worry about it because when it stops being credible, you're here in Washington, stops being credible that we can pass debt, that we can pass, a budget, that we can raise taxes if necessary, that we can get out of from the stupid debt limit. When that stops being credible, that's when R jumps.
So I want you to speak to Secretary Yellen now and everybody else managing this in real time. To Lisa's important question before, you don't have a concern about the sum of our debts right now and the trajectory of them?
In response to Lisa in that question, what I always say is it matters a hell of a lot more what you spend it on and how fast you spend it over time than the level of
How are we
debt.
doing at that?
What?
How are we doing at spending it constructively?
The January package was overshooting. That's a place where I agree with Summers and Blanchard. The January package was too much handouts. But what's in the investment packages that are now under consideration in Congress would be well-spent money.
John?
That was the argument that Larry was making, though, that pushing that forward would take all the oxygen out of the room to enable us to push this one forward. And ultimately, that's what we're bumping up against right now. Adam, what's amazing about this moment for me, and for people that love this material and love this content, they're students of it, is to hear from someone equally as talented, Mohammed Ali, earlier in the morning, taking the other view on all of this, on inflation. And Adam, the question I often ask people is, what's the tell? What do they need to see to say, you know what, maybe I'm wrong about this? What would the tell be for you, Adam?
For me, the tell would be one of two things. Either that we get no real wage growth over this cycle, meaning that we keep having inflation outpace wage growth. That would say, okay, this is all for naught, and so you might as well just go with as hard a money as possible. The other tell would be a large jump in real rates. A large jump in long rates. Now, I think what's going on with my friend Mohammed and others is they're already missing the tell that should have told them to reconsider. Look at Japan, look at US. Their views do not explain and cannot comprehend why rates stayed so low for the last 15 years.
Next time, we need to get you on together. Adam, it's great to catch up, sir, as always. Adam Posen of the Peterson Institute. Tom, that's the framing of this debate right now. Mohammed Ali on the one side, Adam Posen on the other, and they've got company on both sides. Good company, too.
It's good company. This is what it's about. When we invented Bloomberg surveillance, folks, you get the top minds here, and they agree to disagree. I would emphasize they have some very constructive overlays where they jointly agree.
From New York and D.C. for our audience worldwide, this is Bloomberg.
Is inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Climate risk is a financial risk. Countries all over the world have recognized it. But in the United States, we seem not to have fully taken this on board. And I'm very concerned that the chairman of the Federal Reserve has not taken on board the real risks associated with climate change to our financial system, to our banking system.
Good morning, everyone. From Washington in New York, Bloomberg Surveillance on Bloomberg Television, Bloomberg Radio, the laureate from Columbia, Stiglitz, with a ferocious defense of the International Monetary Fund, and the managing director, Georgieva. This has been something with bank earnings and all, a bit off our radar in this week of international economics, but now we dive full into it. And it is good that we can do it with Vitor Gaspar. He is Fiscal Affairs Department Director at the IMF, but that fancy title barely describes the respect for the balance sheet worldwide that world leaders have for the gentleman from Portugal. We're thrilled he could join us in our studios. Welcome to Bloomberg, Vitor.
Thank you so much, Tom, for having me.
I want to go to the issue at hand, and I know you do not speak for the managing director. That would be inappropriate. But to your fiscal model, you talk about strengthening the uncertainties that are out there within our fiscal process. How does your IMF prove through your department, your PhDs, its data integrity in the coming weeks and months? How do you show, not tell?
Data integrity and analysis integrity is absolutely core for us. I'm very proud of my colleagues in the Fiscal Affairs Department, and we have a very robust process to ensure data integrity and the soundness of our analysis. It involves both our department, but also other departments that in the review process vet our data, vet our forecasts, vet our analysis. I think that we have one of the most robust processes of vetting in the world, and we're always striving to improve. For example, the Independent Evaluation Office reviews how we conduct our business, makes recommendations. Those are addressed to management, they're analyzed in the board, and we make constant progress in the way that we produce data and analysis.
The joy of what we do here is we just had Adam Posadon from the Peterson Institute with a spirited conversation of our fears of inflation, and that devolves right over to fiscal affairs in the balance sheet. Can we have a normal discussion of inflation given the excess balance sheets we have from this terrible pandemic?
The uncertainty that we're facing has exactly to do with the pandemic, as you put it. The fact that we have dislocations in the balance between supply and demand is creating bottlenecks in specific sectors and price spikes that may last for a while the economy rebalances and makes its transition to a new growth path. In a situation like that, central banks, if inflation and inflation expectations are well anchored for the medium to long term, should look through this transitory price spike and conduct monetary policy with a steady hand.
With fiscal affairs, the leaders of these institutions and frankly world leaders are going to turn to you with the overarching question, can emerging markets do better in crisis now because they have better fiscal affairs? And it does fold back into the governance of the IMF and the World Bank and other institutions, G7, G20, as well. Can you report through your research that emerging markets are more fiscally sound now than they've ever been?
Emerging markets, like all country groups, are very heterogeneous inside. We point out to risks of divergences in the recovery, and inside the country groups, probably the most heterogeneous of all country groups is the emerging markets. We emphasize very much in the fiscal monitor that you just quoted the importance of strengthening the credibility of public finances. We recommend to all countries that they should maintain or build the credibility of their fiscal frameworks because it pays off. How does it pay off?
Right.
It pays off in terms of better financing conditions for the Treasury. It pays off in more flexibility to get financing when it's needed. It's therefore a precious insurance mechanism to have in times of stress like COVID-19.
Then there's China. Explain to us from your chair the transparency of China and your observation on the speculation in real estate in China and what it does to their fiscal structure, both government and private.
Let me focus on the issue of public finance transparency in China. We have published preliminary estimates on the basis of the global debt database that covers public debt, non-financial corporate debt, and household debt. And one of the challenges that we face in the case of China is looking at what is exactly public sector debt, what is non-financial corporate debt, that is private debt, given the role that state-owned enterprises, given the role that local governments, financial vehicles...
Are you confident in that transparency right now, or at least a trend to improving transparency?
I believe that the Chinese authorities have been improving transparency, and they're very committed to improving it further, and we look forward to work together with the Chinese authorities to do just that.
We're out of time. We have an exceptionally busy day in New York with bank earnings and such. I'm pleased to report to you, sir, the American banks are profitable. I hope that'll make the day better at the IMF. Vitor Gaspar with us. He is with the IMF and truly has changed our worldwide debate on the balance sheet and on fiscal affairs. Lisa, James Gorman darkens the door here in a bit. That will be an interesting conversation.
Especially because on the earnings call, he had this to say about the potential Fed taper. He said that it will obviously be a slightly more turbulent market going forward. They are not complacent about that because of the potential tapering in bond purchases, which will happen at the end of this year, at least according to Fed meeting minutes. I got to say, this was a pretty powerful set of earnings releases, and there are a number of really big takeaways. What was your biggest takeaway, Tom?
My biggest takeaway is the magnitude of fear. We may get some difficult earnings, but I'm not sure they're going to be, to use the phrase, the crater that so many talk about. I could be wrong on that.
No, and certainly for the bank earnings, it is anything but that. I'll tell you my big takeaways. First, advisory fees absolutely knocked it out of the park. Record fees across the board, basically companies combining M&A massive, and you're seeing that borne out. To me, the fact that Bank of America saw its credit card book expand was really significant. There's incipient signs of perhaps some consumer growth, consumer loan growth. That also is a big deal in equity trading, also knocking it out of the park. The big question is, though, in my mind, is how much is Bank of America getting market share versus a widespread increase in the balance sheet of consumers?
My big question is, I'm going to be at some fancy foreign embassy, Lisa, at 10 o'clock tonight, and all I'm going to ask is for them to put on Giants-Dodgers.
Oh, yeah? Is that so? You're going to be there at 10 o'clock tonight? You've got to be somewhere tomorrow morning.
No, down here, I'm living.
You're
the
living?
Emery Horton hours.
Okay, so everybody watch out tomorrow. Tomorrow we'll see Tom Keene after
tomorrow,
a full...
Friday, we'll continue from Washington and New York.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
From New York City.
We're here in London, in Sydney.
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make, and what changes they are actually bring to this market.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This equity market is looking good this morning from New York City. Good morning, good morning. Up 0.9% on the S&P. We advance 40 points. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, more cracks in the transitory narrative.
We know we have inflation.
Inflation is rising.
Ratcheting higher every day.
As you start to see the stickier numbers take hold.
It's no longer seen as short-term transitory.
Unless you embrace the analytically meaningless phrase of persistently transitory.
This really does not look like transitory.
This continued message of transitory.
Transitory.
We all hate the word transitory, but really, I mean, we are looking at a significant supply-demand imbalance.
Is inflation transitory or not?
The problem is that this inflation sticking around for longer than people were expecting.
Inflation has been a little bit more consistent.
And the longer the central banks wait, the greater the risk.
It's those sticky numbers which we really need to watch.
The sticky inflation story.
It comes down to, do you believe in central banks?
Joining us now is Wells Fargo's Michael Schumacher and Julie Beale of Kane Anderson Rudnick. Julie, let's begin with you. The challenge to team narrative right now, how big is it?
You know, I think if you look at inflation overall, two major drivers have been wage inflation, which I think is here to stay, and the persistent housing challenges in terms of pricing, both for renting and for buying. Those have been pretty sticky, but now you add supply chain, which at first I think we all thought, okay, this is just going to be with us for a few months, but now it looks like it's going to stretch into months and years. It's so backlogged out throughout the chain. I mean, I live in Los Angeles. If you drive around the ports in LA, it looks like a Trader Joe's parking lot after work. I mean, maybe less violent, but you know what I mean.
I know what you mean. It can get violent. It can get violent. I love that term from Mohammed, though, in the opening sequence of this program. Persistently transitory. Mike Schumacher, it's analytically flawed to say something is persistently transitory. I just want to understand from your position, at some point, the base case has to change. This is how we started the year. Base case, plausible story. Inflation's going to be elevated. We will have transitory factors driving that connected to the reopening of this economy. As the year progresses, that story fades. I got it. Then we started to talk about the balance of risks around that base case starting to shift. Upside risk to inflation, that made sense. Now I want to understand, Mike Schumacher, from your perspective, whether the base case needs to change. The consensus view needs to shift. Does it, Mike?
It does, John. It's interesting. If you look at the Bloomberg consensus forecast for U.S. core PCE for next year, I know it's a mouthful, but still, it's up quite a bit. It's up about 0.8 for the year. Wells Fargo forecast is up something like that. The Federal Reserve's own forecast from the dots is up only 0.4. So it seems to us that the market is moving at a pretty good clip in terms of beefing up that base case forecast for inflation, but the Fed is lagging. Other central banks are also very concerned. I thought the most interesting stat, frankly, yesterday on inflation, John, is in the Fed minutes from SEP 22. It mentioned inflation 79 times. Back in July, it mentioned it 9 times. Things are shifting quickly.
They are shifting quickly, and there's a challenge for this market. This is what Julian Emanuel of BTIG had to say about it. Take a listen.
The question is the pent-up demand that theoretically may be there in contravention to the very poor sentiment numbers actually going to materialize, or are we going to get into a situation where the concern about inflation being a more permanent part of the landscape actually holds back demand?
Julie, this is one of the big questions of the moment. I'd love your thoughts on it. Will higher prices ultimately start to hurt growth?
I think in the interim, no, because there's so much backlog for demand for items, right? You know, if you're buying a car, there's a long wait list. You know, everything you're trying to buy typically is on a much longer cycle. And these are slower moving cycles for much of the supply chain. But I do think over time, there is a risk that these higher prices really do limit demand, because some businesses can price against this and some businesses just can't. I think too, with consumers, eventually higher gas prices have to take a toll on them. And it's important to remember that year over year, last year we had enthusiasm over the release of the vaccines and stimulus checks, and consumers don't have that this year. And I think that's going to impact their enthusiasm for holiday spend.
Mike, what's your view on that? Same question to you, your take.
Yeah, pretty similar response. I think the point about inflation sapping consumer confidence is excellent, and it takes time. It's not a 1 week thing or a 1 month thing, but over the course of 3, 4, 5 months, yes, if inflation is eroding earnings, the wage gains don't look so spectacular, consumers might say, well, I don't really have a lot more dollars in my pocket in reality after adjusting for inflation, so I start to feel a bit poorer. And the supply chain aspect is going on and on. And we read about it every day. Now, it seems the chip shortage will be here through at least next year. And lots of other examples abound. So it's pretty tough to say that we're going to have a quick fix to this. And I think it does hurt growth.
Mike, you mentioned the earnings. Let's talk about the earnings. This morning, dominated by the big banks on Wall Street. We've heard from Morgan Stanley, from Citi, from Bank of America, from Wells Fargo, a whole host of banks reporting this morning. Putting it all together, Bloomberg's Shonali Basak. Morning, Shonali.
Good morning, John. Investors really have something to hold on to today. You see the stocks of all of those banks now up on the morning, even though we still see some weaknesses in the consumer. So why is that? When trading is moderating, each of them are still bringing in gangbuster figures. You have Citigroup, 40% jump in equities, Morgan Stanley retaining its lead. Fixed income has dropped at all the businesses, but not as much as expected. And advisory revenues tied to mergers and acquisitions absolutely through the roof. $1.2 billion at Morgan Stanley brings it in line with pretty much JP Morgan right there. So it leads the bar very high for Goldman Sachs tomorrow. It's a competitive business here. Equity underwriting for Morgan Stanley also above $1 billion. Hot IPO market as the volatility is not scaring investors away.
Shonali, before you run away, let's talk about your interview at 10:30 Eastern Time with James Gorman and Morgan Stanley. Number one question right now for you. What is it, Shonali?
Margins, 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 margins. Everyone is fighting to pay talent, John, and let's see how they can keep doing that, attracting more bankers to keep competition nice and hot, as maybe even deal making starts to moderate as well.
Shonali, thank you. Looking forward to the chat a little bit later. We'll catch up with you around the opening bell as well. Those stocks are doing okay. Let's talk about the bond market. The big move for me right now, it's not on 10s. Yields have been lower recently. They're a little bit higher this morning on 30s by 2 basis points. They've been lower there recently as well. On 2s, that's where we've had the move. 2-year yields yesterday at almost 40 basis points. In about a basis point right now at 0.35%. There is a belief, increasingly so, that the incoming data will start to push this central bank, the Federal Reserve, to hike interest rates. This is the take from Priya Misra of TD. She says the following, quote, "The market is betting that the Fed will be forced to hike soon. We don't think so. The Fed will be reluctant to call this inflation persistent, so they won't react." Mike Schumacher, I'll read that one again for you. The market is betting that the Fed will be forced to hike soon. We don't think so. Do you?
We think the Fed will not hike, John, in 2022. Things will have to shift pretty dramatically. It's conceivable, but very unlikely. I think what's much more likely is that the Fed contemplates a hike, let's say, maybe Q1, Q2 of 2023. So we think the market's ahead of itself. It's all well and good to say the Fed has to react to inflation, but Chair Powell's talked about this new mandate now for the last year and change. Will he put it into practice? I think he'll probably try. So we do think the market's pushed too much on the front end so far.
Julie, we've had a big push at the front end. Do you think we're pushing too much?
It's hard to say, right? Because right now we went from having maybe 5, 6, 7 members concerned about inflation to now half of them are concerned about inflation. And for sure, they're going to take action first on, the purchases of treasuries and mortgage securities. And I think that will come people like me who are very concerned about inflation. But it's very possible that if that the inflation is persistently high, they're not really going to have a choice. And what's concerning is we don't have a lot more tools to manage that, given where we're at right now.
Are you positioning for higher rates then, Judy? What are you doing?
we're really focused on businesses that have pricing power. That's typically a kind of business that we're attracted to anyway because we're long-term holders. So for us, it's absolutely critical in this environment to focus on those that have a differentiated business that can do well if we are in a stronger economic recovery or if we're in a weaker one. So that's what we really try to focus on.
Mike Schumacher, what's your conviction call right now?
Yeah, for us, John, we think the Fed's going to taper pretty soon. Central banks have become super concerned about inflation globally. I think you want to go away from the trades that will do well if the central banks hold. So it's a mouthful, but think about, let's say you mentioned the 2-year Treasury. I'd stay out of the way of the 5-year. It's already gone up a bunch in yield, but that's really the crux, the fulcrum of the yield curve. If the Fed tapers, that part gets hit pretty heavily. We think taper happens pretty soon, probably at the next meeting, so stay away from intermediate treasuries.
Interesting. That rate hike dance has been playing out in the belly and increasingly so at the front end of the curve too. This equity market's looking good this morning. 20 minutes away from the opening bell at 42, advancing about 1 full percentage point. Coming up, President Biden accelerating his efforts to tackle supply chain disruptions.
We're investing aggressively in building out American supply chains so we never again are at the mercy of another country.
The latest from D.C. Up next, this is Bloomberg.
At the low point of the Greek economic debacle, what were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms, and I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is across-the-board commitment to going to 24/7. This is a big first step in speeding up the movement of materials and goods through our supply chain. But now we need the rest of the private sector chain to step up as well. If federal support is needed, I will direct all appropriate action. And if the private sector doesn't step up, we're going to call them out and ask them to act.
President Biden tackling supply chain issues, announcing efforts to bring major U.S. ports online 24/7. The White House economic advisor Jared Bernstein calling it a resilience issue.
The word I would use here is resilience. We simply have to build much more deeply resilient supply chains. That's certainly the goal that he set out for our supply chain task force.
Joining us now from Washington, Bloomberg's Anne-Marie Hordern. Anne-Marie, you know how this went in the UK this time last year. You mentioned that earlier this morning. It's a challenge for the president going into the holidays.
John, can you imagine empty shelves when it comes towards Christmas and the end of the year and the holiday season, and you just cannot get your goods? This would be a political nightmare, similar to what I mentioned earlier about Prime Minister Boris Johnson, the headlines were he was a Grinch and he stole Christmas. But what you heard the president say there, this is a first step. And that's what the analysts are saying. RBC's Michael Trent says this is just one piece of the supply chain, one piece of that very long line. What about the labor's market? What about those truck drivers and the warehouses? This is going to be not the end of this story when it comes to the supply chain issues that not just face the United States, but economies around the world.
Let's be clear here, Anne-Marie. Some of these issues are not the president's fault, not the fault of this administration. Globally, everybody is dealing with the same thing. Are they sticking, though? Is this what's hurting him in the polls? Are people blaming him for this?
He's the president of the United States. As he has said, when it came to foreign policy, the buck stops with me. The individuals in power, and that right now is the Democratic Party, constituents, consumers, that is who they are going to really hurl their annoyance and grievances at. So the president is just trying to do what he can, but you do make the point. Everyone is dealing with this. And this is because we shut entire economies down and switch them back up. There are going to be sticking points and problems when you do that. The president is trying to move his administration to really be the interlocutors between those companies as well as the labor unions to do what they can to try to start streamlining some of it.
AMH down in D.C., our Washington correspondent. Anne-Marie, thank you. Away from the blame game down in D.C., for us, a couple of questions. How long does it go on for, and what does it mean for margins? Let's deal with the first point first. Brian Yarbrough of Edward Jones expecting this issue to get a whole lot worse. He says the following: I don't believe we've hit the peak in terms of how bad it will get. On the phone, I'm pleased to say, TPW's Jay Pawlowski. Jay, let's start right there. How bad can this get for you?
John, great to be with you. There's a reason why I don't like technology stocks, right? Because I can't deal with the tech. Apologies for that.
No worries.
Look, I think the supply chain issue is already fully discounted in the markets. It's already being resolved. As a friend of mine in Asia said, the fact that the president has to kind of force ports to work 24/7, which is SOP, standard operating procedure in Asia, is a pretty amazing statement and kind of reflects where we are in this country on a number of fronts. I think the issue is in process of being resolved. The price of containers from China to the West Coast in the U.S. has halved over the last 2 weeks, has halved. And so that is the lead signal. I think this is in the price and it's not something to be worried about.
Well, Jay, let's talk about what's in the price. What's the tell in the market right now that maybe the market's gotten over this as well, or increasingly so, there are some signs of it?
Yeah, I think, look, there's two things that confirms the synchronized global expansion that you and I have talked about for some time. The first is the breakout in oil. The second is the breakout in rates. This week, we got the Australian dollar-yen cross confirmation. We have Dr. Copper up 5% in the last 2 days. We have the Jets airline stocks wildly outperforming ACWI in the S&P and the Qs over the last month. I think there are a number of signs, John. If you look underneath the S&P and you look into the rotation from growth to value, which you know is one of my main transitions, it's underway as we speak.
Jay, let's get a call then before you have to run. Let's get two. What would you fade and what would you get long right now?
Well, I would definitely fade big cap tech, and not just because I couldn't get live with you on screen today. Rates are going higher. Growth is going higher. We're having a synchronized global expansion. There are opportunities all over the place, John. There's value in cyclical stocks. There's European banks. There's China equity. There's Japanese equity. I would probably go, if I had to pick one, I would go with Japan equity. I think that's the big upside opportunity. A big market has made a little breakout, came back in, and I think is going to break out for real over the next 6 months. Completely under-owned, very cheap, cyclical with stimulus and growth ahead in 2022.
Hey, Jay, I love how personal this tech story is for you. Buddy, let's reschedule and catch up soon. JP Pawlowski there, TVW. Back with us, I'm pleased to say. Mike Schumacher, Judy Bill. Judy, you heard that conversation. I want your view on it. Have we seen the worst of this?
I don't think so. I think, it starts at the very beginning of the chain. One underreported story, at least in the U.S. markets, is the power crisis that is occurring in China. And the two forces of the power crisis and COVID shutdowns mean that factories are really mired in terms of being able to maintain a strong schedule. And so I think that's going to just reverberate through the rest of the cycle. It's wonderful to see President Biden asking the ports to stay open 24/7, but the LA ports do something like 950,000 containers. It's going to add 3,500 containers. It's not going to really move the needle. And the bigger problem is that the majority of supply chain is really driven by the private sector. And so there's very little he can do. He can act as a good faith broker, bring everyone to the table, but the struggles with finding labor, the struggles with just finding warehouse supplies and warehouse storage are making it very, very difficult. So in this case, I think the strongest players will be the largest retailers that can flex in and out of their capacity. You see Amazon trying to find used Boeing planes recently. I think they want to have as much control of their supply chain as possible.
Judy, why has that name done nothing for me this year? Why has it struggled so much?
I think it's just run so much. You know, it's natural for these names to kind of take a breather. We saw that with all of the tech last year just exploding as the work from home, everything with work from home occurring. And then the minute the vaccine was announced, we moved over to value and cyclicals. And so I'm a big believer in reversion to the mean and the need to own quality names. So I think in the near term, for sure, you can make an argument for cyclicals, but I think over the longer term, it's really hard to know if they're going to be able to maintain this momentum that they have.
Two views on either side of the debate right now from Judy Beal there and Jay Pawlowski on the other side. Mike Schumacher, this was the quote from Brian Yarbrough of Edward Jones. I'll read it again. I don't believe we've hit the peak on supply chain issues in terms of how bad things will get. Mike Schumacher, on which side of the debate right now do you fall?
I guess I look at it a bit differently, John. I think the peak, no peak question, it's not really the right one to ask. The more critical point for markets and investors and for your audience is how quickly do these things resolve? And in my view, and the view of most of my colleagues here at Wells Fargo, it's going to be a slow process. And you can look at whether it's ports, whether it's chips, other aspects of the chain, they seem to be improving at a very slow clip. So I think it's going to be a pretty long, slow move, slog for the markets, and that's the real issue.
Well, I'll get to the market question then, Mike. I think this is the important one. I hope you'll agree, and you won't give me a better question again. Do things just need to stop getting bad? Do they need to stop getting worse? They don't have to necessarily get better, but stop getting worse. Is that enough for risk appetite?
I'm not sure. That's an interesting point, John. So it's the second derivative. If you want to think about this mathematically, is that enough to get people excited? I question it. I think you probably need true improvement rather than simply slowing the degree of worsening. So I'm going to go with we need to see improvement.
What about you, Julie? What would your answer to that question be?
Yeah, I would agree with that. I always struggle with second derivative. I'm not great at math. But I do believe that we need to be a little bit more focused on the fundamentals in order to feel confident. And I think that's true because valuations are high pretty much across the board, and we're facing a higher interest rate environment. So I think there really is a point where investors have to look at what am I paying relative to what can this business do in terms of its earnings power. And, you know, the second derivative is helpful in terms of our feelings, but at a certain point, we really have to be able to compare the business to the valuation.
For the record, I'm terrible at maths too, but I'm happy you're both sticking with me. Judy Beal, Mike Schumacher, sticking with us. Your equity market up 0.9% on the S&P, advancing 40 points. We've got a lot of bank earnings to get through. We'll do that in a moment. Your morning calls and later, the big banks giving futures a lift, reporting better than expected results pretty much across the board. That conversation is just around the corner with Piper Sandler's Jeff Hart. There's only one more bank to go. It's Goldman tomorrow. More on the banks just around the corner from New York City this Thursday morning. Good morning. Equity futures advancing 0.9%. The opening bell 7 minutes away. This is Bloomberg. 5 minutes away from the opening bell this Thursday morning. Good morning. Let's set the stage for you. Your equity market has a nice little lift, higher by 0.9% on the S&P, on a Russell up 1%, on the Nasdaq up 1%. That's the equity story. Let's just sit on the bond market story just for a moment. At the front end, we've started to pull forward rate hike calls. Your two-year yield's been shifting higher. Yesterday, just short of 40 basis points. 39 basis points or so. Right now, about 35. Yields in almost a basis point there. On your 30-year, where yields have been going lower, they're about a half a basis point higher at 2.0322%. That's the story in the bond market, the price action for you. Here's some morning calls as well. Let's start first up with Morgan Stanley downgrading Avis budget to underweight. The analyst seeing a negative risk reward following the stock's 300% rally this year. We're negative there 4.28%. Your second call from Stifel, upgrading UPS to a buy, 224 price target, seeing solid fundamentals and a healthier operating backdrop. That stock is positive 2.25% at 188.20. And your third and final call from KeyBank, upgrading AT&T to sector weight. The analyst seeing limited room for further downside following recent declines and some strategic adjustments. We're positive there 0.6 to 25.45. They're three of your calls. Coming up, the bank earnings parade marching on. Piper Sandler's Jeff Hart joined us at the opening bell to break it all down. With Goldman Sachs, the only big one still to come. From New York, your cash open is next. Your equity market is positive. This is Bloomberg.
Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. There aren't many times in economic history, I don't think, where things are this divided on the economy. For the market, for market historians, where things are this divided on the market. The debate is so polarizing around inflation, around the economy. and around equities too right now. We're up about 40 on the S&P. We advanced by 0.9%. That's the opening bell. Switch on the board and get to the bond market. A shape of things as follows on treasuries. 10-year yields looking like this. In a basis point, 152.64. That's really, really choppy. In the FX market, reclaiming a 116 handle on euro dollar. Just about. We're flat there. We're positive 0.05%. And crude back at 81. WTI 81.13. Advancing 0.7%. We'll call it positive 0.9% on the session. We open higher then by 0.9% on the S&P. Healthcare leads up by more than 1 full percentage point. Information technology up by 1.1%. The financials up about 0.8% this morning. That's the story. The big banks taking center stage. A number of the earning calls underway. With more, here's Sonali Basak. Hey, Sonali.
Hey, John, you do see a lot of confidence exuding from the big banks today. They are still talking to investors, some of them. Morgan Stanley just ending their call. We're focusing now on businesses outside of investment banking. For James Gorman on wealth, he made a big statement. He says it's real. We're getting very big teams coming in, especially as they start to build that wealth management unit into an even bigger juggernaut in the United States. So, you know, when we think about that pay pressure, you wonder if it just is delegated to the investment bankers alone. He says part of the reason for this is that big equities business. So Gorman pitching the synergies of the business. You move over to Citigroup and you have Mark Mason saying, we're not sitting still as it relates to the competition. They are speaking there about their credit businesses. We heard a very similar statement yesterday from JP Morgan when they talked about their big competitors. You know, we've been worried about consumer credit, but some businesses at Citigroup, such as installment loans, doing a lot better, showing that they're able to compete even though this environment is changing very, very fast.
So, Sonali, we had JP Morgan yesterday. We've had Bank of America. We've had Citi. We've had Morgan Stanley. We've had Wells. Goldman still to come. Have we got a pretty decent read on what to expect tomorrow morning from Goldman Sachs?
The bar is so high, right? We want to see Goldman Sachs. They are going to need to beat expectations as well as meet some of these numbers that we're seeing over at JP Morgan, Citigroup, and Morgan Stanley for this surge in equities. Investment banking as well. The fact that JP Morgan and Morgan Stanley each brought in $1.2 billion worth of advisory fees. That is where Goldman Sachs is perennially number one. So what do their numbers look like at the end of the day?
Sonali, thank you. Looking forward to the coverage tomorrow through the day. And of course, that interview with Mr. Gorman, James Gorman of Morgan Stanley, coming up on Bloomberg TV and on radio, 10:30 Eastern Time. For more on the banks, let's bring in Piper Sandler's Jeff Hart. He's got an overweight rating on Bank of America and Citi. He's neutral on Morgan Stanley. 3 banks under your coverage, all reporting this morning. Jeff, let's start right there. Your take, please.
I mean, we're getting pretty good results, and I think the key this quarter was more about the outlook than necessarily the kind of the rearview mirror of what actually happened in the quarter. We knew capital markets would be strong, and they proved to be a little stronger than we thought. But the outlook commentary has been pretty positive there, and that's good for the banks. And those that are deploying their excess liquidity, we didn't get as much of it from JP Morgan, but certainly from B of A today we did, are seeing some net interest margin improvement too. Hopefully loan growth shows up. That's kind of the important thing bank investors are all watching closely for. And again, all the preliminary signs are there that we'll see it, but we're not necessarily seeing it yet. But I still like the universal banks, right? It's the B of A's, the JP Morgans, the Goldman Sachs's of the world, because scale matters more now than ever, and they have it. And capital markets is, I think, an underappreciated story. Those revenues aren't going to really drop off anytime soon.
So what separates Bank of America and Citi, your 2 overweights right now, Jeff, between, say, Morgan Stanley, where you're neutral? What's the big distinction there?
You know, the thing with Morgan Stanley, and I've been wrong there, it's been an outperformer, even though we've had a whole rating on it, is kind of in the wake of the E-Trade and Eaton Vance acquisitions. It seemed to me like the benefits were all kind of priced in, you know, so it seemed like it was priced for perfection. But what we've been seeing is, their capital markets franchise, especially in sales and trading, has proven better than I think it's keeping up with all the big boys. And in wealth management, they're really kind of bringing in the assets and really showing the beyond just synergies, but the actual, you know, what they gain from combining those two. So, I mean, it's been a great stock and it's performed really well. I do struggle a little bit with the valuation here, but they've clearly delivered.
Mr. Gorman keeps getting it done. I think a lot of people, Jeff, struggling with the valuations at the moment. As I've repeated over the past 24 hours, many of the guests have come on the program and said this is one of the areas of this stock market that's actually got more expensive through the year. Is there a cap, Jeff, on how high we can re-rate some of these valuations on some of these names?
Well, I think that the key becomes what's going to drive the next leg up, right? I mean, especially for banks in general, you've seen a strong month, right, as the 10-year has gone up. And typically the 10-year moving upward is much better for bank stocks and for bank fundamentals. We actually need shorter rates to come up more for bank stocks. But I think to kind of move from here, you need to see credit quality stay good, and we need to start seeing some of that loan growth to really kind of help net interest margins or net interest income, as well as capital markets strength. So I think there's still room to go in the banks, but certainly, you know, the run over the last month has taken some of that upside off the table.
Jeff, just quickly, you brought up something important. I get some messages about this sometimes, and I'm with them when they say it. Jeff, why is it that the market seems to be very preoccupied with the 10-year yield? That the stock seems to trade around that, yet when you think about profitability at a bank, it's all about the front end. What's that about, Jeff?
Well, I mean, the 10-year yield is kind of the proxy for interest rates, right? And especially more long-term interest rates, which tend to be an indicator of kind of economic strength. So if you're seeing the 10-year going up because the economy is good as opposed to inflation growing, I mean, that's a good economic indicator, and the banks are kind of the oil that lubricates the economy, right? So a good economy is good for banks. So I think it's partially that, but also partially, you know, it's an easy metric to track. You know, if you want to start looking at the 5-year versus the 6-month, that's probably a more meaningful spread, but the 10-year is kind of right out there in front of people. And if you're not a dedicated financials person, you know, that gives you some insight into interest rates that I haven't to dig necessarily as deeply as us kind of bank rats do.
We can do that on Bloomberg, Jeff. You know that. It's good to catch up. Jeff Hart,
Yeah.
It's good to hear from you, buddy. Thank you very much. Very busy morning for these guys. I appreciate their time. We caught up with Baird's David George yesterday. What's been interesting about this conversation around the banks is some people might call them a haven away from the supply chain disruptions. Take a listen to what he had to say.
The supply chain disruption issue is really weighing on corporate loan demand. And it's very simple. Companies cannot get inventory. And if they can't get inventory, there's no need for them to finance that inventory through lines of credit. So as supply chain disruptions start to normalize over the next several quarters, that alone, we think, will result in a step function higher in loan growth, particularly in the corporate area.
Back with us, Mike Schumacher, Julie Bill, waiting patiently. Julie, I wanted to go there around the banks. I think it's interesting there to hear that for the bank analysts, holding back loan growth has actually been the supply chain disruptions. Can I have your thoughts on that?
Yeah, I think it absolutely makes sense. You know, the U.S. is a consumer economy. We love our stuff. I love my stuff. And, you know, for sure, a lot of business is driven around that. So it would make sense that most businesses that are seeing all of their inventory kind of stuck in the chain are not going to be after, you know, short-term loans to finance that inventory. First of all, they're not even sure they can get some of that inventory to begin with. So I think that's going to be a slowdown, at least in the near term for bank earnings.
Julie, how confident are you with this sector at the moment, given the run-up it's had more recently off the September 22nd move from the Fed?
You know, I think there's still a lot of opportunity on the advisory side of the business. You know, although rates are increasing, they're still quite low, and transactions are still out there to be had. There is still a ton of activity on the IPO markets. We're seeing so many more of these larger tech companies that have been waiting and waiting and waiting, and they're coming forward. Even though it's a volatile market, we're still seeing a lot of activity. For sure, the SPACs have kind of gone. And so I don't see a lot of opportunity there, but I still think that on the advisory side, there's a lot of work still to be done.
You heard Jeff Hart there on the importance of the 10-year yield. We can debate that a little bit more. The 10-year right now, 154. HSBC Steve Major actually raising his year-end forecast for 10-year treasuries to 150 from 1%. He wrote the following: with end 2021 in sight, growth expectations are lower and inflation expectations are in the driving seat. High yields may embolden the near-term bear case for bonds. Now, Mike, important to point out that we now have 3-month time horizon into year-end, and this is just a tactical mark-to-market call from HSBC. Nothing fundamental has changed for them. Has anything fundamental changed for you, Mike Schumacher? Your view on this range of 160 to, say, up to 190 on the 10-year. Is that still where you're at, Mike?
It is, John. And the way we see this playing out is we look at breakdown between real yields and inflation expectations. And by the end of the year, let's say in the U.S. case, we think reals for the 10-year, the 5-year, et cetera, become a lot less negative. Still negative, but not as much. So just to put some numbers on that, the 10-year real yield today is minus 90, 95 basis points, something like that. We think by the end of the year, it gets to negative 60, maybe minus 50 if things really go well. Against that, though, we think the inflation expectation story takes a bit of a hit. expectations come off the boil. So if you think about another 30 to 40 basis points in real yield against losing 10 to 20 from inflation expectations, you can get the 10-year up to 180 plus pretty quickly. So that's how we see that mix evolving over the next few months.
Mike, why do you think we struggled to break 180 back at the end of Q1, where I don't think we could have had much more charged up expectations for better growth? Why do you think we couldn't get there?
Yeah, really interesting point, John. I think a few things came together. And when you consider the components of that move, it was a massive uptick in inflation expectations. So vaccines were becoming available. They were being absorbed by different countries at different rates, of course, but there was this huge reopening trade. And inevitably, that hit some speed bumps. And I think that took yields down a bit. So people reassessed. Also, when you consider the mix of bond investors, some are very long-term players. And I think a lot of people out there said, hey, 175 on the U.S. 10-year, high yields and other government bonds relative to where they had been for the prior 12 months. Let's buy some, put them in our long-term investment accounts and just hold. So those two things came together and I think really capped the yields back in Q1.
Mike Schumacher there on the bond market. Julie Beale, just finally to you, a final word on treasuries, if I can, where you see things playing out beyond year end into next year.
You know, I think for us, we kind of believe that inflation is going to be here to stay, and there's just no way that doesn't impact the treasury market. So I think we continue to go a little higher from here.
Julie, thank you. Good to have you on the program. Come back soon. Julie Beale there, alongside Mike Schumacher. Your equity market positive, about 11 minutes in on the S&P 500, up 0.9%. Every single industry group on my screen right now is in the green. Up next on this program, emerging market economies struggling to return to normalcy, leaving central banks left to make some tough calls.
If you look at many emerging and developing economies, we're looking at very significant scarring. You know, of the magnitude of 5% of their output lost relative to where they would have been, even 10% relative to where they would have been. So this is the divergence that we are extremely worried about.
A deeper dive into emerging markets up next. This is Bloomberg.
Surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question. Wonderful. Who of you has a driver's license?
You don't need that.
They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us, as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their mission.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
There's a risk for developing countries that they have the perfect storm. And that means massive cost push inflation imported, especially for commodity importers, lower global growth as China and as the US slow. And then on top of that, the risk of reversal in financial flows. And that's why you're seeing the central banks tighten way before the Fed tightens.
And they're tightening in a big way. Mohammed Al-Erin there, seeing pressure on emerging markets to raise rates. This as surging inflation fuels a recent wave in central bank hikes. For more, let's bring in Damien Sasser of Bloomberg Intelligence. Damien, Chile, Colombia, Mexico, Brazil, South Korea. You reminded me, Singapore in the mix as well. It's never ending at the moment, Damien. What's going on?
Oh, yeah. I mean, look, we have central banks across the board, 11 of 20 majors basically hiking rates. They've all hiked since May. I mean, look, they're trying to stem off the inflationary pressures we're seeing. They're trying to overcome the growth differential with developed markets. The IMF had a great point yesterday. Pre-pandemic GDP growth in developed markets, we're going to achieve that in 2022. Emerging markets, they're still going to be 5% off that level going out to 2024. So they've got their work cut out for them, certainly.
Mohammed listed a whole range of issues here, Damon. I think they're worth repeating. We've got the commodity importers on the one hand. On top of that, the prospect of lower global growth driven by the fallout with China, potentially the US decelerating into next year as well. Then you add in the financial flow risk too. Damon, how different is the experience right now for emerging markets versus, say, DM? What's the big divide at the moment for you?
Well, I mean, we've got to focus on Turkey when you're talking about financial flows because it's just so critical to compare where we are today relative to where we were just in 2013, right? Foreigners have completely exited the market, Jonathan. I mean, I'm talking, you know, it used to be 30% of foreign involvement in Turkish local debt. It's down to 5%. And even more important, locals, local Turkish households, citizens, et cetera, 50% of their deposits are now in foreign currency. So, you know, to convince them to bring their dollars back on shore, convert them to lira, hits a bridge too far, especially with what's going on overnight.
The I word drives me nuts, idiosyncratic in emerging markets, but is that a Turkey problem, a Turkey-specific problem? Given the stance of the president and his latest move to sack, was it 3 policymakers on a central bank of Turkey overnight? Is that a Turkey problem, Damon, or something happening more broadly in emerging markets right now?
No, I mean, it is idiosyncratic to Turkey. It's wash, rinse, and repeat. Look, I mean, you know, obviously we've heard about Erdogan and the fact that he wants rates lower. You know, the central bank has zero credibility in Turkey. And so, look, this is the same old story. You know, he's going to insist on a dovish view. The lira's going to fall out of bed. They're going to have to run through their FX reserves to prop it up. And all of a sudden, we're going to be hiking rates even more aggressively going forward. And I think this is what the markets are going to start to price in, Jonathan.
Beyond Turkey, the energy importers, I'm thinking India. When I'm thinking about the exposure to China, I'm thinking about South Korea and the likes, that exposure to big trade stories. Damon, do you see a similar story playing out there? You know, does it go beyond Turkey? Is there a problem with South Korea right now? Is there a problem with India?
You know, I have to be honest with you. You know, the divergence between emerging market asset prices and commodities has grown exponentially in the last few years. So you really can't look at commodity prices in a vacuum and think that that's going to matriculate through to emerging market valuations. I mean, just look at commodity currencies. Forget about EM. Look at Aussie dollar. Look at the loonie. I mean, they've really kind of decoupled from a lot of, you know, what's going on in the commodity space. But that's not to say that the real economy isn't feeling the pain, and food and energy prices going up and growth coming down and central banks tightening rates on the back of what's going on here in the U.S. It's just not a good recipe.
Have you noticed we're not really talking about China defaults anymore on a daily basis? Damien, why is that? Are we waiting for the market to tell us it's a big issue when you and I can sit here right now and break it down and say it's a big issue? What's going on there? Why are we ignoring what's taking place, which just seems to be a domino effect from developer to developer?
Well, because, quite frankly, financial conditions here in the U.S. are still very loose. I mean, think about this, Jonathan. Emerging market high-yield credit spreads are now in Turkey. We're going to be seeing Turkish banks, which, you know, remember, Turkey is the second largest issuer of EM high-yield credit. Spreads should be widening off the back of this, but we're just not really seeing all that much of an impact in terms of valuations yet. And so if you ask me what's the next shoe to drop, I think you have to look at EM high yield credit. You have to look at EM high yield credit spreads. And as financial conditions here in the U.S. tighten, I think you're going to start to see spreads widen.
My final question to you is actually going to be, which central bank's going to be the next to hike? Who's left, Damien, still to go?
I don't have the calendar in front of me, but it's certainly the next one on the calendar. Look, I mean, we had some surprises last week with Romania, with Poland. You know, people didn't think Poland was going to hike. They were falling behind the curve. They aggressively did it. I think we need to look at South Africa. I really do think that they need to get in front of the curve here. They are desperately falling behind, and I think the Rand is going to reveal that in the not-too-distant future.
Governor Kanyago, a gentleman we haven't been able to speak to for a while. Damien, thank you. Damien Sasser there on emerging markets. EM issues can quickly become DM problems. Not yet, but perhaps, and similar issues as well. Let's get to this equity market. The S&P 500 up by more than 1%. Every single industry group is looking tidy and nice. It's good, it's green. Let's get to the stocks editor, Dave Wilson, for more. Hey, Dave.
Hey, John. You've already mentioned those 11 main industry groups in the S&P 500 haul higher. If you look at what's at the forefront of the gains, though, there are a couple of key earnings reports to play into what we're seeing. Technology stocks leading the way. You had results out of Taiwan Semiconductor Manufacturing, TSMC, biggest chip maker in the world. They went over well, so you're seeing stocks like NVIDIA and Intel and Advanced Micro Devices move higher. Also, the chip equipment makers like Applied Materials. And then with healthcare, it's all about United Health, biggest U.S. health insurer out with its third quarter results. Again, well received. So you're seeing that company's peers at the forefront of the gains. You know, think Aetna and Humana and Cigna and Centene in that group. But one area that has definitely not been keeping up, the banks. I mean, you really have now at this point a sort of a split response in terms of those third quarter results we saw before the opening bell. Bank of America higher, Citigroup moving down, Wells Fargo lower. And one of the biggest regional banks also reported, U.S. Bancorp, and it's down too. KBW Bank Index set a record last Friday. It's been down the first 3 days of this week. And today, struggling to move up at a time when pretty much everything is going higher, John.
Goldman Sachs, your next stop for the big banks. Dave, thank you, sir. Dave Wilson, our stocks editor, on the breakdown of the sector price action this morning. The top line, the index level story, a positive one this Thursday morning. We advanced by a little more than 1%. Coming up, your trading diary, the events you need to be looking for through the next couple of days and into the weekend. From New York City this morning, good morning. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're going into winter and things are getting interesting because we have other energy commodities like natural gas and thermal coal that have spiked. and thus creating substitution back into oil. So the market's tightening. It's been tightening for a while. We could double the deficit into the winter months, maybe triple it. There's a risk that we spike above $100 a barrel.
Francisco Blanche there of Bank of America on Bloomberg TV with a big, big call. He's looking for $100 a barrel by next summer. He said a cold winter, and we can bring that in some 6 months. It's part of the equity market conversation, isn't it? Not this morning, though. The S&P 500 up a little more than 1%. We look good on the Russell. We look tidy on the NASDAQ, up 180, advancing there 1.24%. That's the equity story. Here's the bond market. Switch on the board and get to 2s, 10s, and 30s. The conversation has been pretty much at the front end. Yields have been higher there recently. The rate hike conversation picking up. This morning we go the other way. We're down a basis point on 2s and we're up a basis point on 30s where we've been much lower. More recently, your 30-year 2.04%, 10s dead flat, your yield there 153.51. That's the price action. Here's the trading diary. Coming up at 11:30 Eastern Time, President Biden giving an update on the administration's vaccination program. Then the Fed speak. Richmond Fed President Thomas Barkins, San Francisco Fed President Mary Daly. They speak at 1 p.m. Eastern Time. Plus, Philly Fed President Patrick Harker a little bit later this evening. Then to round out the bank numbers, it's Goldman Sachs rounding things out on Wall Street tomorrow, followed by the big data point, 8:30 Eastern Time. At CPI on Wednesday, we end the week with U.S. retail sales heading into the weekend. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all of this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de...
This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning, who used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for fifth generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there, not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start. From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to USA, 24 people went for the job. 23 people accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们差。我们在座的所有人的脑袋绝不比你们差。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma's an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.